Stocks slip after a firm open despite in-line US and India inflation prints as uncertainties in the US drive IT stocks lower. Realty and FMCG are the two positive spots.
TCS pulls IT services stocks lower after it misses revenue and margin expectations and cites uncertainty about the future. Analysts worry that the healthy order book may not entirely translate into revenues.
Just because there's a CEO change, as I was explained before, it need not mean there's a strategy or structure change. We'll go through things like whatever is required, we will do. I don't expect anything new.
Tata Consultancy Services or TCS's CEO designate K. Krithivasan says he won't change anything at the IT services major. The pronouncement spells continuity.
AU Small Finance Bank surges after its CEO gets a 3-year extension in term from RBI. The development raises questions over why IndusInd Bank's CEO got an extension of only 2.
ONGC Chairman Anil Kumar Singh tells CNBC-TV18 that the new gas pricing regime is positive and in line with global price benchmarks. He adds that all new wells will now earn $9.5 to $10 per MMBTU.
Hey folks, welcome to Halftime Report. I'm Sonia Shenoy and with me as always are Ekta Batra and Mangalam Malu. It's a market that's not doing too much. I think the only space that's buzzing is IT, and because of the drag on IT, the overall index is a tad bit lower. But other than that, there's absolutely nothing happening. A few stocks here and there, an AU Small Finance Bank, etc. But the market is just buying time. There are, of course, many cues to watch out for. There's the Infi numbers later in the evening. We're heading into a long weekend. People may not want to keep their positions open, and we have good gains under our belt as well. So all in all, you'd have to say it's a market where people have perhaps checked out, going into the long weekend, checked into the long weekend already, and a bit quiet with IT on the downside.
Yep, par for course perhaps, after the kind of gains that we've seen. Also at the same time, some people would have thought that at some point the market may run the risk of running into some sort of resistances. And it was getting very easy to just buy the dip. Mind you, the day is still not over. Maybe in the last hour we have some people buying the dip. But the IT index, pressurizing the Nifty on the downside. The technicals coming in the way for the Nifty Bank as well, which is just above, just below the 100-day moving average. So a lot of things playing out.
Absolutely. Well, it's turning out to be a session where at least the macros are behind us as of now. So we do have the earnings to look forward to. And obviously, it will be the Fed meet, which takes place in May. So that'll be the other port of call in terms of cues for the markets when it comes to the macros. But there's a lot buzzing in today's trading session in terms of stocks.
Absolutely. So Apollo Hospitals, right? I mean, it's the first stock on our radar. I think the stock is up, It's just about 10% away from its 52-week high. Now, there's so much happening here. And I think the eventual goal that the street has with Apollo Hospitals is when that deal will take place and when the financial investor will come through. But you tell me, Ekta, why are you watching the stock today?
Well, Sonia, in the past 2 weeks, I think I've joined Surbi on who moved the markets, talking about pharmaceuticals and healthcare. And one of the key things that I pointed out is that every time there is any kind of rise in COVID-19 cases, there's some amount of buzz and interest which takes place in a lot of these pharmaceutical and healthcare stocks. But I think the market is now understanding that the severity of COVID-19 is not as much as before. But nonetheless, in terms of Apollo Hospitals, what we are watching today is that the stock is just about 10% away from its 52-week high. It's trading at around 22 to 23 times FY24 EV to EBITDA. It is one of the more expensive hospital stocks within the entire sector. Now, the reason for the up move, a couple of them could be the fact that there is that Manipal Temasek deal which is done, which took place just a couple of days ago, and that took place at around 10 times FY22 sales. Remember, it is the second largest hospital player after Apollo Hospitals. So the street is now hoping and bracing for the fact that there could be an up move in terms of valuations because of that particular deal. Apollo Hospitals is trading currently at around 4 to 5 times FY22 sales. So there's a huge gap in terms of the valuations. Now, in terms of Q4 earnings, that is something that the street is watching quite closely. there is an expectation that they could surprise on the upside versus estimates of a flattish quarter. Generally, this quarter could have been impacted by factors such as holidays in January, etc. But the occupancy is expected to be at around 64% versus 65% on a Q-on-Q basis, with the expectation that it could surprise on the upside. Now, in terms of COVID-19, like I mentioned, India reported over 10,000 new COVID-19 cases. As of now, no hospitalizations due to the severity of the cases, so that's definitely a positive. Triggers, margin improvement fell to 11.9% in Q3. EBITDA was dragged down by what was the highest ever quarterly investments in Apollo 24/7. Apollo Healthco Digital Health and Pharmacy, which is basically the digital health and pharmacy business, reported a net loss of around 63 crores in the previous quarter. So any kind of improvement in those metrics, as well as fundraising, they said they are capitalized for 6 months, and within 6 months they should get an investor for Apollo 24/7. Where do things stand? That is something that the street would watch out for. Lastly, there is buzz of a Mumbai-based privately held diagnostic company on the block, so there is hopes that there could be a deal in the offing on that one as well.
Okay, in fact, let's ask Sriram Rathi. He's the India analyst who tracks the pharma and healthcare space at BNP Paribas. So let's welcome him to the channel. Sriram, thanks a lot for joining in. First, overall on the sector, right, I wanted your thoughts. I mean, there is a lot of buzz that's taking place across segments, as Ekta was also pointing out. Where do your preferences lie for the long-term investor now?
Yeah, so thanks for having me here. In our preference list, we prefer companies with largely India pharma business, focus on that segment. And at the same time, we like diagnostics more than hospitals now. Though we have positive view on all these three segments, the pecking order will be India pharma, diagnostics, and then hospitals. And US generics remains a tactical play. Structurally, we are not very positive on that segment, but tactically, in the near term, we may see positive surprises out there.
Right. As far as the M&A space is concerned, are you seeing any sort of need for consolidation in the diagnostics space? And if that was to happen, how would you play this area?
So diagnostics, M&As may happen out there. We have seen a couple of large deals in the last 12 to 18 months. So that is mainly to fill up the geography gap largely. But otherwise, it's more of an organic growth story, and we prefer Dr. Lal more out here, though we have positive rating on Dr. Lal as well as Metropolis. And we believe that the companies which are able to grow organic growth on consistent basis, so we will prefer that company more.
Okay. Sriram, what is your view on the Manipal Temasek deal and what the read-through could be for the entire hospital space and for companies such as Apollo?
Yeah, so the deal, of course, is one of the largest deal in the healthcare hospital space, valuing the company at 10 times sales. That looks very high, clearly. But of course, it was for a majority stake, so that could have been possible. And read through in terms of, I don't think any valuation to accelerate for the sector as such because of that deal, because it's more of the growth and occupancy which will determine the valuations going forward. And currently, if you look at last 3 quarters have been quite good for hospital companies, largely driven by improvement in the revenue mix, and that we believe would have been on account of elective surgeries, which will gradually taper off. So structurally, we are positive on the space, though in the near term, we may see some pressure on the occupancy as well as on the revenue growth.
So on names like, in the diagnostic space, you said that, your pecking order is first you like the India pharma business, then diagnostics, and then hospitals. So within diagnostics, do you think the worst of the pricing pressures behind, worst of the competitive intensity, and what kind of recovery? Do you think names like Metropolis, etc., could get back to their highs that they saw perhaps a year or two ago?
Yeah, so we are definitely seeing that the competitive intensity and pricing pressure is behind us now. We have seen that the new online players have been increasing the prices over the last few months. That clearly shows signs of basically pricing pressure bottoming out clearly. And from here on, we expect that there will be marginal increase in the prices by diagnostic companies with the large organized chains like Dr. Lal and Metropolis. So clearly, this is an inflection point for the sector, and we should start seeing performance improving in terms of growth to double-digit revenue growth, and that will lead to the valuation relating back.
Okay, all right. Sriram, that's on the diagnostic space, but one stock which stood out yesterday was Divi's Labs. The export data is something that the street has started following closely just in the past couple of months for the likes of Loris, Divi's, Gland, all of the others. How closely or how relevant is that export data to determine how exactly Divi's is going to do in the quarter? And secondly, what is your view on Divi's?
Yeah, so of course, we don't have access to export data, but whatever we saw on our channel, it looks like, clearly Q4 numbers look very high. Generally what happens, like March month is always better for API focused companies because that is the month when most of the sales are being booked for the quarter. But if I look at those data and look from the YUI perspective, so it's not very far from what the street is expecting. It may be marginally higher. So our view on Divi's is positive, but at current price, the upside is very limited. So probably we'll look out for a better price to enter into the stock.
Right. And as far as pharma itself is concerned, what are your thoughts? Are you looking at domestic focused pharma or some of these export names? Because up until now, a lot of people were focusing on domestic itself, citing the opportunities here. But the decline that we've seen in a lot of these export names, and like how Divi's did well yesterday, citing some sort of improvement there. Do export focused pharmaceutical companies also come on your radar now?
Yeah, so domestic is something which is a structural play from the long-term perspective that we always prefer. US, as I said, is more of a technical play in terms of export business. And currently, what we are talking about, what we are hearing is that basically pricing scenario in US is stabilizing to some extent. And so the companies which have a decent product portfolio and have clear FDA status will be more preferred. So from that perspective, if you look at companies like Aurobindo Pharma or Dr. Reddy's are better placed from that perspective.
Okay, all right. Sriram, we leave it at that. Thanks a lot for joining in and speaking to us on CNBC-TV18. By the way, I just want to mention that Infosys is really taking it on the chin now. The numbers come out later in the evening at about 5 p.m. or so. The stock is now down 3%. So after the weakness that we saw in TCS's numbers and the weak management commentary, Infosys is the one now that's taking a knock. Let's slip into a quick break. On the other side, TCS, Infosys, the entire IT pack will be in focus, so don't go anywhere. So as I was telling you before the break, Infosys really is the stock of the moment. The expectation is that the numbers could be on the weaker side. Also, it's the first time Infosys will give out its FY24 guidance. It's the first time we'll hear from any IT company on FY24 guidance, perhaps. So, those numbers are also crucial. But TCS reported their quarterly numbers last evening. Reema's here with the earning report card. Reema, how are the numbers?
So TCS has missed the mark on revenues and margins. Revenue growth at just 0.6%. Margins didn't expand contrary to management's expectations. EBIT margins at 24.5%. The management commentary was quite interesting. The management told us that at the beginning of the quarter, we were anticipating North America to bounce back. But the sentiment turned in the month of February and March. So at the beginning of the quarter, they were penciling in a 1.5% to 2% growth. But by the end of it, they just ended with a 0.6% growth. So that's the expectation of the miss compared to what they were anticipating and what really transpired. Discretionary projects got put on hold, not just in BFSI, but there was a spillover in manufacturing and auto. And what happened is, because the revenue loss was there compared to their anticipated, the costs continue to remain at the same level, which is why the margin expansion also did not take place. The other worry from an analyst point of view is that there is still no uncertainty. The order book is looking very robust, $10 billion, but there is always a possibility that these orders don't take off immediately. Clients put them on pause, as we've seen. And so that's the worry, right? The near term continues to remain fairly uncertain. BFSI has slowed down to 9.1%, slowing for the third consecutive quarter in a row. But the silver lining in the numbers is the deal wins at $10 billion. Back to you.
Okay, all right, Reema. Thanks very much for that. In fact, let's listen in to what the top brass of TCS had to say on the quarter gone by.
Later part of the quarter, because of the uncertainty that came around the BFSI sector and its implications on the overall macroeconomic setup. That's where the miss in terms of what we were expecting versus what North America has been growing very strongly for us. If you look over the last 8 quarters, for the first time in a long time after the pandemic, we have actually had a sequential degrowth in North America. So we were thinking that the quarter should come in at somewhere in the 1.5% to 2% range. That would have also met the other side of it. It has come in at 0.6. So that's the extent of the miss. And almost entirely, I would say that I would think North America is where the shift is.
Our exposure to US regional banks is very, very immaterial. Like in our overall scheme of things, I would say on a revenue basis, it could be less than about 3% of our revenue. It's very immaterial. We own just 3% among banking alone, right? The uncertainty is still lingering and it will be there for some time. So customers are likely to prioritize certain kind of projects over others.
All right, with that we go across to Surabhi. Surabhi, what are brokerages saying about TCS?
Well, TCS is one stock that has divided the street right down the middle. We are talking about target prices that range from 4,500 on the upside to 2,700 on the downside. So let me take you through the bull's view, the bear's view, and also all those who are in between. The company's fourth quarter miss has got the bears out in full force. JP Morgan has been underweight on the stock for quite a while, with possibly one of the lowest target prices on the street at 2,700 rupees. The bank says the BFSI weakness was unexpected and the uncertainty on tech spends will lead to a softer first half for TCS. JP Morgan has cut its revenue and EPS estimates by 1 to 2% respectively. The next big bear is Nomura with a reduced rating and a target price which is just below JP Morgan at 2,850. Now Nomura says the near-term business visibility is low and also points out that the headcount addition in the fourth quarter has been weak and that TCS has missed its margin guidance for the entire year, that's FY23. Citi is also part of the bear camp with a sell call and a target price of 3,000. The bank feels that valuations are still high on the stock and street estimates on margins may have to be trimmed given the impending wage hikes. Now let's see how the bulls are seeing the TCS story, the green side of the screen. Macquarie has one of the biggest targets on the stock. They have an outperform rating with a target price of 4,510 and that's a 40% upside from where the stock is right now. So what's Macquarie's argument? They're saying that revenue and margin miss is due to temporary issues. The brokerage argues that deal wins are strong and that the business is still poised for growth. The brokerage expects TCS to get back to its target margin band of 26 to 28% this year itself. That sentiment is echoed by Bernstein, which points out that the order book remains healthy, even though there is uncertainty on BFSI spends, at least in the here and now. Bernstein has an outperform rating on the stock. Their target price comes in at 3,560. Let's move on and talk about the next participant in the bulls camp. That's CLSA, another big TCS bull with a target price very close to Bernstein at just around 3,550 and an outperform rating. CLSA says that TCS's structural strength will actually support the company in this uncertain IT spending environment. Compelling arguments coming in from both the bulls and the bears, and that brings us to the fence sitters. Jefferies has a hold rating on the stock with a target price of 33.75. Morgan Stanley has an equal weight rating. Their target is 33.50, just below Jefferies. So Jefferies is sounding a cautious note on the client uncertainty and the subdued headcount addition that we've seen from TCS in this quarter. It has also cut its earnings estimates by 2 to 3%. It expects TCS to deliver a 6.7% constant currency growth. Morgan Stanley says it's not yet clear if client sentiment has troughed out in this quarter, in Q4 itself. The brokerage says that valuations are still quite high and they're higher than the long-term average, making the risk-reward unattractive. So there you have it, the black, the white and the grey of all the street views on TCS.
Okay, pretty mixed this one. Thanks a lot for that. But I guess now we're going to move on, right? We're going to look at Infosys, which will report its Q4 numbers later today. And that's what the street is very cautious about. Rima is here with more details on what to expect. Rima, this is the first time perhaps we could hear about some FY24 numbers as well. And after the commentary that TCS made, Infosys investors are a bit jittery.
Absolutely. So if Infosys commentary echoes that of TCS, where there is a lot of uncertainty and it's difficult to get a demand visibility, I think the street is going to be a bit worried. Let me quickly run you through the key expectations. A dollar revenue growth of just 1.3%, a constant currency revenue growth of 0.4%, but the range of estimates is quite wide. So for Infosys, you've got a Morgan Stanley, which is expecting a negative growth, minus 0.1%, and you've got an Antique expecting more than a 1% constant currency revenue growth. But if the growth is less than 1%, it will be the lowest growth that we've got since the COVID quarter, Q1 FY21. Margins flat at 21.5% and profits also flat on a sequential basis. The key is going to be the FY24 guidance numbers. For FY23, the company is clocking in revenues of 16 to 16.5%. Next year, analysts are saying growth could slow down to 6 to 8%, though there are many on the street who also expect a 5 to 7% growth. The margin guidance is going to be critical. Currently, expectation is that the upper end of the margin guidance is going to be raised to 21 to 23%. What will you watch out for in terms of commentary, particularly BFSI? Because even before this whole regional crisis and the regional banks crisis in the US began, growth rates for BFSI have been slowing down for Infosys. So in Q3, BFSI growth rate was just 5.5% versus an average of close to about 12-13% that it used to see. Recently, two presidents of the company stepped down. One, Mohit Joshi, who left to join as the CEO of Tech Mahindra, and you had Ravi Kumar, who joined as the CEO of Cognizant. Also, deal wins. Deal wins for TCS were very strong, and for Infy as well. Last quarter, they were very strong. If the deal wins are strong, it will be a silver lining because it does give you some visibility over the medium term. Back to you.
Okay, all right, Reema. Thanks very much for that. So that's an emphasis just about.
Welcome back. We're virtually at the low point of trade for the frontline indices. The Nifty down below that 17,750 mark as well. And we're seeing some sell-off come by for the Sensex too. The mid-cap index, which is outperforming by virtue of not falling as much as the frontline indices, has a few stocks which are doing extremely well. DB Realty is one of them, not a stock that we usually speak about, but a big upsurge on that counter in just the last 15 minutes or so, and it's locked in upper circuit of 20% with fair amount of volumes. BASF has been doing well, just the way a lot of these agri/fertilizer plays have been doing well over the last few trading sessions. And some of these textile exporters, the likes of Welspun India, we're seeing decent growth come by in the share prices of Nitin Spinners, etc. as well. Good time to get in some perspective on the FNO space then. It is weekly options expiry today, and the market is seeing some softness after 8 days of gains, and it's the IT index which is dragging the Nifty itself. The Nifty banked to facing some sort of resistance at the 100-day moving average, 41,710. That corresponds to a 100-point difference from where we are on the Nifty bank right now. And as a result of which, a lot of call writers are coming into play today. After a couple of days where we saw call writers cover their short positions, the 17,800 call writers are active today, 17,850 call writers as well as 17,700 put writers too. But on weekly options expiry day, we have people who write straddles, which is a call and a put together, and that is most active at the 17,750 mark where we are right now. So the 17,750 call and the 17,750 put come up for you, and both of them together have a premium of 60 odd rupees. So that's telling you that the option writers are eyeing a range of 17,690 to 17,810 for expiry today.
Okay, well, let's put that question to Prakash Gaba then, who's going to give us, I guess, some ideas as well on what one should be doing in trade. Prakash, it's not looking so good right now for the market. It's slipping a little bit to the low point of trade. In fact, already down 75 points. And then there's this whole IT overhang, right? Post TCS's numbers, ahead of Infosys numbers, the street is a bit cautious. How are you approaching it, and what are the stocks to watch?
Well, good afternoon to you. Yes, what we are seeing is kind of a blowout. In the sense, we saw a good up move. Then we've got resistance near the resistance zone, which has been a traditional resistance zone. Now, if it has to cross that resistance zone, it needs to spend some time in the lower region and then take that out. If that happens, then we are out of the blues. But so far, it looks like there is some kind of weakness, and we may perhaps see a weakness for a couple of days more. We have 3 days of holiday now, Friday, Saturday and Sunday, long weekend. So I think next week maybe it could be a tad bit weak or maybe a sideways zone. So there is no trade on the buy side on the Nifty and the Bank Nifty. Exactly the same, because the Bank Nifty kind of formed a double top and Nifty is seen a strong resistance zone. However, we have some pockets of strength, and I would like to go for strengths like possibly Havells India. Yes, Havells India looks good to me. Very good chance Havells India can climb up to maybe zones of let me see the levels out here. Havells can climb to maybe around 1210 zones. It's trading at 1193. I would have a stop below 1180, and then maybe 1210 is possible. Second stock that I like is HDFC Life, seeing a good momentum, trading at 529 zones. Possibly we'll see a move to 540. I would have a stop below 525 on HDFC Life and trade long here. Small pockets though, yes, but there is some strength in isolation.
Okay, all right, Prakash, we're going to go and let you enjoy that long weekend, Friday, Saturday and Sunday off. Thanks very much for joining in, and we'll speak to you on Monday. Well, that is on the technicals, and another pocket of strength definitely has to be the mid-cap index on a week-to-date basis. It's gained around 1.4% as compared to the Nifty, which is up around 0.7%. So there's definitely some amount of resilience which is coming in for the broader market stocks at least. On a week-to-date basis. Even today, the underperformance is less as compared to the Nifty and the Sensex. Take a short break, but up next, we'll put the focus on AU Small Finance Bank, which is buzzing today along with a lot of other stocks. Stay tuned.
Well, it is getting a bit tough for the market right now. So move to the low point of trade, 80 points low on the index, and it's IT that's dragging. But on the upside, AU Small Finance Bank is surging. This after the Reserve Bank approved the extension of the tenure of the MD and CEO. Ritu is joining in with details and some brokerage views as well. Ritu, over to you.
That's right. RBI has approved the reappointment of Sanjay Agarwal as the MD and CEO of AU Small Finance Bank for a 3-year period until April 2026. And the tenure here is very important. Remember, the board had already approved Sanjay Agarwal's reappointment in January last year. In addition, RBI has also approved the reappointment of Uttam Tibrewal as the whole-time director of the bank for another 3 years. Now, what this does is it removes a big overhang on the stock, because in the context of the 1 or 2 year renewals that have been granted by RBI in some recent instances, take IndusInd Bank CEO's case, for example, this 3-year extension for AU Small Finance Bank CEO is definitely a positive outcome. So Kotak Institutional Equities believes that the fresh development addresses a key discussion point for investors, and now the interest is squarely going to shift back on the bank's operating performance. AU has been indicating strong trends in collections and asset quality. Advances and deposits growth has also been healthy. Now, Morgan Stanley is overweight on the stock with a target price of 860 rupees. It expects the stock to stop derating given the full tenure extension and a peaking of the interest rate cycle. Going ahead in the next few years, it sees a strong re-rating of the AU stock. Citi has a buy rating on the stock with a target price of 740 rupees. It said that RBI's approval reflects a stance of confidence and expects the stock to unwind and see improved visibility of the bank sustaining 1.9% return on assets.
All right, Ritu, thanks a lot for that. That explains the sort of move that we're seeing on AU Small Finance, up almost 15% right now. But the government's amended the domestic pricing model of natural gas in line with the recommendations of the Kirit Parikh Committee on Gas Pricing. To discuss the impact of this new gas pricing, earlier today we spoke with Arun Kumar Singh, who's the chairman and CEO at ONGC. Let's hear him out.
So effectively from new wells and the intervention wells, ONGC will get 9.5 plus, something between 9.5 to 10. So depending on what price crude varies. And this part, new wells, you may be aware that every year, 8 to 10% production gets added for new wells. Ultimately, what's happening? It is 10% of crude price plus 20% you get on account of this, new wells. So any new investor is going to get 12% in India of the crude price, which is the international average. Today, gas price would get calibrated if it remains linked to crude. The slope of 12 is considered universal when you link it with crude. Old wells every year get replaced by new wells. So now in 3-4 years' time, you can see ONGC at par with the international market. Even in gas, oil, it is already at par with international market. In gas also, this limit of 6.5 is only for the old wells. It is not for new wells.
Okay, so that's on ONGC, but Eicher Motors and Ashok Leyland are also surging in trade. This is after Goldman has initiated coverage. Sonia, tell us more.
So, the thing is, the auto stocks have done really well this week, this month, this year. I mean, if you look at the year so far, Tata Motors and Bajaj Auto are the big gainers, up about 20%. Goldman Sachs has written an interesting note. On Eicher Motors, they're quite positive, actually. They have a target price of 3,660, which is well above the current market price, and they've initiated a buy. They believe that the EV EV disruption that will happen over the next 5 years, Eicher Motors faces the least risk compared to its peers. Not just that, Eicher has given a very long R&D cycle. They have a higher bar as far as the specifications of the premium motorcycle segment is concerned, in the electric space that is. Also, their product mix is improving, hence they can improve their margins as well, as they're getting good margins from the international market too. There is the international business program which is expanding. They have 10 new products in the pipeline, and some of their recent products like the Hunters 350cc as well as the Super Meteor 650 have received good response. So that's why Goldman likes Eicher. Now on Ashok Leyland, they have initiated, but they have a neutral with a target price of 140, which is somewhere around the current market price. They believe that after 2 years of very good growth, now there are some signs that the commercial vehicle cycle is easing a tad bit, and hence they are, a bit cautious here on Ashok Leyland. They say that we have entered a mid-cycle phase in the Indian commercial vehicle market, but despite all of that, they're looking at a 25% EBITDA growth over FY23 to 26, driven largely by the company's steady performance in the light commercial vehicle business. And they also like the fact that the company has a lot of plans for modular vehicle ranges as well as alternative powertrains. This could, sort of help them with their product portfolio. So these are two stocks on which Goldman Sachs has initiated a coverage. On Ashok Leyland, a bit cautious but very bullish on Eicher Motors. Let's slip into a short break. We'll continue our focus on the auto sector in our segment Quarter Se Quarter Tak. We'll analyze the earnings expectations from the sector. Stay tuned.
Welcome back. Well, on to our special segment now, Quarter Se Quarter Tak. Sonia is here. She's gone off to the big wall to take us through the earnings expectations from the auto sector in Q4.
Well, the auto sector has seen its growth momentum slow down in Q4 across most segments. Now, dealer surveys indicate that new order inflows at passenger vehicle dealerships has slowed down, while the medium and heavy commercial vehicle demand recovery remains on track, driven by infrastructure spending, and there is a margin improvement is also on track due to price hikes and lower commodity costs. So what are the revenue expectations this time around for the entire sector? Now, brokerage firm Nomura expects a revenue growth of about 15 to 35% in the commercial vehicle segment, a large part of it coming in from Tata Motors and Ashok Leyland. Within two-wheelers, if you look at it, Hero MotoCorp and Bajaj Auto are expected to see a 9 to 11% top-line growth, which is slower than its peers in the other segments, while TVS Motor is expected to do better with about a 20% growth, largely because of its exposure in the electric vehicle space, the iQube, which has done very well. In fact, passenger vehicle manufacturers like Maruti as well as M&M will see a higher growth due to a low base effect of last year. A growth of around 22 to 28% is expected in the revenues for Maruti Suzuki and M&M. I'll also be watching out for commentary very closely, commentary on demand trends which have been slowing down across segments, while another area of concern has been the export markets, as we know, which have remained weak for two-wheelers. So any commentary on recovery in the export market will be watched very closely. Let's also leave you with a valuation table for FY24 and FY25. Now, if you look at it within the passenger car space, M&M is still inexpensive compared to peers like Maruti. M&M still trading at around 15 times FY25 compared to Maruti at about 20 times. If we move to the two-wheeler space, Hero MotoCorp is still the cheapest stock, trading at a 20% discount to its own historic average and compared to its peers as well, because of rising competitive intensity and a loss of market share in its core motorcycle segments.
All right, Sonia, thanks a lot for that. So that's what one can expect from the auto sector in this quarter. With that, we'll slip into a short break and focus on the commodities arena. We've spoken a long bit about equities itself. Manisha Gupta joins in with Atul Ghanatra, who's the president at Cotton Association of India.
Welcome back. Joining us on the show now is Atul Ghanatra. He's president at Cotton Association of India. Mr. Ghanatra, hi, thank you so much for joining us. I want to first start with the USDA report, which suggests that the Indian exports for this year are going to be at a 19-year lows. Last year, we've done a number of 42 lakh bales, and this time around, their estimate is of 23 lakh bales. What is your sense?
Yeah, good afternoon, Manisha ji. Last year, our export of cotton was 42 lakh bales. But this year at CI, we have expected cotton export will be around 30 lakh bales. But looking to higher Indian cotton rate, we may reduce cotton estimation export from 30 lakh bales to 25 lakh bales. And up to March, 11 to 12 lakh bale has been shipments are done. And from April to September, 12 to 14 lakh more bales will go. So, yes, from last year, 42 to this year, 25, around 17 lakh bales export will be reduced.
Okay.
Also, looking to our lower cotton production and higher Indian cotton consumption in future, very soon, Indian status of net cotton exporter country will change to net cotton importer country, Manisha ji.
That doesn't sound so well, Mr. Ganatra. But if you look at the global cotton prices, we are trading at a 4-month lows on that as well. And as you said, Indian cotton is not competitive at these current levels. If you look at the numbers across board, do not look good. The global trade also has been at the lowest in last 6 years. There is weak demand from China, from Turkey, also from Bangladesh for that matter. How are you looking at the current season for cotton globally also?
Globally, demand is less, but what happened in India, after last 2 years, huge profits done by the spinning mills. There are 20 lakh new spindles have been added in last 15 months and 10 more lakh spindles are in pipeline, which will be start up to September. So Indian mills, due to consumption is higher, Indian mills are having very good demand of cotton as they are running on 100% capacity and with small profit. So Indian market at present it is around 62.5 to 63,000 for Gujarat Sankar 629 mm. It looks like the rate will be steady now, but this cotton arrivals are good now, so mills are getting cotton. But once after May arrivals will start reducing, then cotton prices will slowly go up, and we assume that cotton price may touch to 70 to 75,000 in June, July in India. So it is a good time for spinning mills to cover, Manisha ji.
Mr. Ganatra, also we've seen the prices come in on a positive side. From the lows, at least, we've seen buying come in right now. Earlier, there was this concern about higher cotton prices and not too many spinning mills, and the capacities had gone down as well. Would you say that situation as of now seems to have cleared out?
No, now it is cleared out. It is a good time for the spinning mills. Mills are making small profits and running 100% capacity. So from last 2 months, Indian mills are making profit, and I am seeing good future of the Indian spinning mills because China is slowing down, Bangladesh is slowing down. So all this demand from China and Bangladesh are converted to India, and we can see in Tirupur hosiery business also, Tirupur exporters are having very good orders in hand for the summer and winter for the Europe and USA.
Mr. Ganatra, also, what are the kind of arrivals that we are seeing into the market? You've said that the crop is lower than last year. The arrivals also have been on the weaker side. What is it that the farmers are looking for in sense of returns?
Up to March, we have received the arrival of 190 lakh bales compared to last time, same time, 250 lakh bales. So this year we are running behind by 60 lakh bales, and looking to the arrival, everybody, 90% people in the trade believe that crop is short and our yield will be the lowest in this year, and we are expecting the pricing will not go up more than 300 lakh bales up to September. So looking to our higher consumption and lower production, rate will go up in the coming months, and we will be having a little tough time after June, July. Yes, Manisha ji.
Mr. Ganatra, I have one final question. And as you said, after being a net exporter of cotton for years and decades, if I may add, we are turning into a net importer here. Is there a representation that you as an association are making? I mean, are you approaching government? Do we need changes in measures right now?
Definitely. The main problem is our yields are reduced drastically. India is having the lowest yield in the world. We can say 50% of the yield against the Brazil, USA, Australia. So if we want to survive in the textile industry, we have to bring the new seed technology immediately, and our production, which was one time 40 million bale, is reduced to 30 million bales. We have to bring new technology of the seed. We have taken up this issue with many times with the government, and talks are going on from last 1 or 2 years, but we have not seen any results for bringing the new seed technology. It is a need of our, Manisha ji.
Okay, all right, Mr. Ganatra, thanks a lot for stopping by, and Manisha as well. Thanks for joining in and talking about the commodities market. But let's get back to the equity market. Although the headline index is not showing it, there's some pressure that's definitely creeping in, and it's all courtesy the IT names. So not just the frontline IT guys like Infosys, HCL Tech, Tech Mahindra, but now even the ones in the broader market. Remember, TCS was the first company to release its numbers and that cautionary note, but now that's taken the sentiment down with it across the board. So something like an Emphasis is also under a bit of pressure as we speak. And even in the broader markets, a lot of financials are now coming off, whether it's a Bandhan Bank, whether it's a PFC, REC, a couple of other names, Bank of Baroda, IDFC, First Bank, are all trending in the red as we speak. So not a great market at the moment. It's held up though by auto stocks and the consumption piece. So something like an Eicher Motors is your top Nifty gainer. Dabur is doing quite well in the broader markets. So in that context, there are winners and losers, but largely you'd have to say after 8 straight days of a run up, a little bit of give back is what we're seeing in the market at the moment. But with that, it's a wrap on this edition of Halftime Report. Thanks a lot for watching though. Don't go anywhere. A lot of action will be taken forward in our program Business Lunch. Stay tuned.